back today, and not only are we talking about a trend in digital media and marketing, but we're talking about my favorite trend, which is industry consolidation. After all, that is LUMA's day job, is to intermediate M&A. Maybe, and I am super delighted to be joined by Anna Milicevic of Sparrow Advisors. Anna, maybe just while we're continuing to build an audience, if you can just sort of give a snippet about, I know you from multiple companies in this sector and have found you to be an incredibly smart and cogent thinker as it relates to what's going on, and with an added quality of sort of calling a spade, very unfiltered. That's why you're here. But maybe you could give a background about Sparrow.
Thank you, Terry. It's lovely to join you here. And yes, we have known each other for quite a long time. I'm the principal and co-founder of Sparrow Advisors. We're a management consultancy in the space. Some of you on the webinar probably have worked with us or should be working with us already. But we focus on solving the hard problems in Ad Tech and Martech. So whenever you have a strategic problem and you need a POV that affects multiple functional areas, or just need some help with a really gnarly problem, we are the Ghostbusters to call. Our team is split across New York, Boston. We have a team in Europe and a couple of other locations. So we are pretty much everywhere as our Sparrow namesakes. And yeah, today we're going to be talking, I think, about a really, really interesting topic altogether. So I'm really, really psyched.
All right, so I am going to move to share my screen so we can get launched into things here. So here we go, ladies and gentlemen, the LUMA's Work From Home webinar series. Today we are talking about the state of industry consolidation. It's an interesting time to be doing so. We were sort of, we frequently talk about this topic and get asked about this topic quite a bit, understandably, from our clients. And of course, there is an added relevancy given the dramatic changes of the crisis of COVID-19 and its impact on this topic. But I think what you're going to hear largely from Anna and I today is this notion that we were sort of on a path towards certain trends, certain consolidation trends in the sector. Really what the net effect of COVID-19 is to accelerate those existing trends. So to dive into things here, I just want to remind everyone that this is part of our Work From Home webinar series every Wednesday at 2 p.m. Or as we call it, Appointment TV or Must-See TV. We'd love to have you join us for these webinars. We have a series of topics. As I mentioned, we're covering from Stream Wars, we've done identity as an aberration. I talked about comedy in business. And today we're talking about the state of industry consolidation. By the way, all of these webinars are available VOD, so we post them all to YouTube. So if you're registered and you're on, you want to send it around to folks or just watch it again, you know, if you're having trouble sleeping, whatever, then you can always take a look at it. And just to sort of pimp next week's show, if you will, we are going to be covering emerging trends in marketing. And I am delighted to have my good friend Jeff Ramsey of eMarketer, brilliant guy. Too bad he doesn't have enough passion when he presents. I swear to God, the dude is on some kind of uppers, but filled with data and also no filter, because in that session, we're going to address, you know, all of these buzzwords and three-letter acronyms about the, you know, shiny new object kind of trends, and really parse them in terms of calling which ones are real and which ones are bullshit. And there's a lot of both, more the latter actually in marketing. And so we're going to kind of be pretty clear on those type of topics. That's next Wednesday, April the 8th. Okay. Here we go, state of industry consolidation. So what I'm going to do is, format-wise, I'm going to walk through a few slides, hand it off to Anna to give some commentary on their perspectives, the Sparrow Advisors sort of perspectives, which, by the way, you will find to be highly aligned with the way we thought about this. It was a blog post of Anna's and Maya's back in March on Ad Exchanger that I found, read, and said, oh my God, that's exactly how we're thinking about the world. And so that's what prompted me to invite her to join us today. And then Anna and I are going to mix it up after that and have a dialogue conversation and hopefully answer as many of your questions as possible. And we will end this one at 3 o'clock on the dial. Otherwise, my manager's going to I'm going to be in trouble. So let's launch into it. You know, and by the way, we have some wonderful sound effects here for your entertainment enjoyment. Every industry goes through an arc, and I would call it an arc of new company formation, maturity, and rationalization and consolidation. And I mean every industry goes through this. So, this is not unique to ad tech. There are some differences, however. Most industries have an arc where the aggregate or the peak amount of companies that get formed in any particular subsector are enumerated in dozens or maybe even hundreds. Take, for example, ERP software. There were 150, 200 vendors in the mid 80s. Today, there are 6 of any consequence. So again, it's natural for these industries and subsectors to go through this arc. Ad Tech and Martech, however, is a little different in the sense that they are, it's like it's on steroids, right? It's the same sort of arc, only a combination of factors. The fact that these are naturally sort of digital companies with not a lot of physical assets. Number one. Number two, the cloud infrastructure that became available made it really easy to launch a new company. And third is the ubiquitous availability of cheap venture capital. Basically meant that like we had our arc, only the new company formation side of things kind of got a little out of hand with literally thousands of companies. And as we'll talk about, there'll be a consequence for having that prolific a new company formation phase. So it turns out that if you actually map the data, it's actually not far off this sort of notion of this sort of smooth arc. Here is the input data, financing deals in Ad Tech and Martech over this decade period from 2009 to 2019. And what you'll see is a peak where you had the maximum amount of deals occur in the year 2014. Now to take a look at it on the flip side, and by the way, a total amount of $16 billion in total funding. Now, if we look at the output, it turns out that it follows a similar arc pattern, only this time, we've sort of advanced the peak 1 year to 2015. So the year with the highest number of exits in Ad Tech and Martech was 2015. And we have been in an era of net consolidation since then. And here's another interesting point. Of the 1,900 exits that transpired over this decade, a mere 96 of them were greater than $100 million in value, which is today is going to serve as our proxy for a strategic deal. Now, notice that that is 5%. So 5% are quality exits. Bear in mind, I know that there are quality exits below 100 million and not so great exits above, but let's just use it as a rough proxy. 5% scaled quality exits in that time period. That's going to become important when we a little bit later on. If we were to take a look at this sort of end game phase, this rationalization and consolidation phase, you'll notice that in consolidation, if we, by the way, adding the first quarter year-to-date annualized data, you'll see that it's dropping further. It was going to be down from 2019 pre-COVID, and obviously COVID knocked the socks out of the transaction activity. So we're definitely in the 5th year of this decline. And the point we tried to make here is that not all exits are equal. Here is our prognostication on rough numbers as to parsing these sort of types of outcomes that we believe will take place amongst the remaining thousands of companies, independent companies that exist in the ecosystem. And I know, this is harsh, but it's our closest approximation to reality, and so we're gonna stick with that. We believe a full 75% of the companies in this space will capitulate or fail outright. Capitulation just means selling for less than invested capital. It's basically a rescue trade, or they'll simply close down or file for, yes, bankruptcy, sadly. That leaves another category, we believe 20%, and these companies are going to need to be sold. You're likely going to hire an investment bank and run a process to try and find a buyer.
And right here, 125.
Very much so in an auction process. There we go, until such time as you find a buyer. And then only 5%, and really it's only 5%, that are essentially going to be, it's not only LUMA, but it's certainly how we approach the market, which are going to be the strategic deals, the deals that you always hear about, that VCs make their careers on, the huge returns and the fantastic wealth creation opportunities for entrepreneurs, is in this sort of 5% bracket. And there are really unique characteristics of these different types of exit outcomes. Allow me to point out a few. So first of all, in the capitulation and failure category, again, 75%, sadly, of outcomes, these are really distress deals. They're distress deals caused most often by running out of cash, right? And your existing cap table investors are reluctant to fund the company with additional cash. They tend to be catalyzed by your own investors or creditors if you trip covenants. The outreach scale, look, you're going to call everybody and their sister to try and find a home, a soft landing for this thing when you come to the realization that you have to act. The valuation will be based on whatever is available. You're really not terribly picky. And often those valuations fail to return investor capital, let alone satisfy creditors. Or if creditors are owed money, obviously you're well aware, they rank first in terms of recovery. Oftentimes the creditors don't get their money back if things really go south. Now compare that to the second category, companies sold. These tend to be financial deals based on the buyer offering the best terms in your auction process, catalyzed in fact by the company in a process run often by an investment bank. The outreach scale will be significant because if you're going to sell, you want to uncover any and all buyers. So you kind of just call everyone in the ecosystem to see if they're interested. Valuation is very much based on company results, and the multiple on that valuation is often an input. What do I mean by that? I mean that the buyers are going to say, oh, okay, you're doing 46 million in revenue. Well, I'll give you a 2x multiple of that. Or in this category, more often, they'll say, oh, and you're doing 7 million of EBITDA, I'll give you 10 times or 8 times or whatever the multiple of EBITDA. But the valuation the multiple is very much an input. Now compare that to the third category, the companies bought category, representing, again, in our math, roughly 5% of outcomes. These are not distress deals. These are not financial deals. These are strategic deals based on a buyer's need for the target's technology. They tend to be catalyzed by inbound from the buyer, from the strategic, or coaxed on by what we call nuanced strategic discussions. The outreach scale tends to be quite small, under 20, and I'd say more often mid-single digits, because after all, you got inbound from one company, or you instigated or primed some dialogue with one strategic company, and you might on the back end of those discussions run what we call a market check and call the half a dozen most logical parties. The valuation is very much based on the value to the buyer. So they figure out what the value is worth, and then they argue about how much they have to pay you. And the valuation multiple, this is really important, tends to be an output, usually based on revenue. So again, if it's strategic, it doesn't necessarily have to be profitable. And the buyer, even though these multiples tend to be really large numbers, the buyers don't think of them in that context. They think of the value of that capability in their hands with their network and their customer base. And then they figure out what it's worth to them, what they have to pay for it. Then you do the division to get the valuation multiples. Now, if you compare across these three categories on these parameters, these look like very, very different types of intermediation. I mean, we obviously we at LUMA try to stick to that third category, and it doesn't always work. We will sometimes end up doing deals in category 2, and who knows, for the bizarre situations, it may even end up in category number 1 if things don't work out well for our client. And now, because we are LUMA and we have no filter, I'm going to name names. So here we go, folks. Examples of capitulations, that category: AdBrain, iView, Ignition One, Seismic, Verve, Videology. These are recent examples of companies that sadly, unfortunately, either had to close operations, file bankruptcy, or sell for less than invested capital. And by the way, cue the CEO email outrage to me in 3, 2, 1. I don't care. The facts stand up for this. Good examples of companies in this middle category. Again, these were decent exits, right? These were greater than invested capital. So check the box on that. But there basically had to be a process run by an investment bank to find a buyer who would offer the most. And I think these were decent outcomes. But again, none of these outcomes are going to materially improve the marketing materials for the venture capital investors that were in them. And then the third category, these are names that, you get heralded as high watermark examples of great companies in the space that had great outcomes: AdMel, Clip, Datarama, Market Share, Mode, TapAd, just to sort of select a few of those. And look, we've done deals in all three. So, we intermediated the Videology transaction largely because we felt this was a very strategic company. It sadly just had a creditor problem and ran out of time and had to file bankruptcy, and we sold it in that 363 process. We intermediated the Simplify transaction on the last go around, whereby we identified a private equity buyer. And by the way, notice that private equity buyers are really get to play in this sort of second category, rarely the third. And yet the preponderance of the deals we've done are in this third category. And by the way, I charitably included Datarama just to demonstrate that, yes, you can have a strategic exit without hiring LUMA. That's a joke. But this is where we have the preponderance of our intermediation. Here's the interesting thing. You can get what we call a boomerang trade. You can get a company like, let's say, Unruly, that does a deal. We sold Unruly to News Corp for $180 million. And then, 3-4 years hence, they ended up selling it, sadly, for a materially smaller amount of money. It ended up being a capitulation trade by News Corp. And notice we didn't intermediate that one. So these are very, very different outcomes for companies in the space, depending upon where they sit. Just to hammer home the point, here's the average revenue multiples of exits in each of these categories. And if this doesn't sort of ring true to prove the point about the variety of different outcomes, less than 1 times for the capitulation trades, about an average sort of median multiple, 4.5 times for the middle companies. And I mean, the sky's the limit on the third one. Incredible, significantly into double-digit multiple for the third category. So it really does matter how you intermediate. To put this in another sort of lens, we took a look at the Gartner hype cycle, only we applied it to ad tech. So instead of a technology trigger, which Gartner utilizes, we started with an M&A trigger. And very much that was what we call digital media spring fever. In the course of 1 month in the year 2007, 4 transactions totaling $11 billion in exits were transacted, which really caught the attention of a lot of venture capitalists and potential entrepreneurs to launch businesses into what looked like, or certainly what was, a high growth sector that had a lot of promise. Amongst the top companies in the space, we had punctuated by Invite Media, which sold in 2010 at a record-breaking 54x multiple of revenue. Now, nobody, including Google, thought of this as, I'm going to pay 54 times. It just so happens, again, that's the output of what you took a look at their financials at the time and the valuation, and it turned out to be, it was 54 times. Or that's on a relative basis. On an absolute basis, you had Rocket Fuel, which ballooned in October of 2013 to a $2.3 billion value. So you had this sort of 3.5-year wave window towards the top of the sort of peak of inflated expectations, to put it in Gartner's terminology, where you had these crazy multiples and everyone wanted in on ad tech, which is probably why many of these companies pursued an IPO path. We had a parade of 8 companies that went public to, I would say, a mixed bag of results. And it very much reminds me, it's so apropos, right? And typical that, retail gets in late, just before the crash, and crash it did. Again, taking the Rocket Fuel example, not to pick on them, but they sort of are the poster child of this Gartner hype cycle. Here we were, private equity-backed Seismic acquired Rocket Fuel for $145 million in 2017, marking a 94% decline from their $2.3 billion value just a few years prior. And if that doesn't sort of punctuate the decline, it turns out that wasn't all the way down. Seismic then filed for bankruptcy a little bit more than a year later. So it turns out that they were catching a falling knife. And that, I think, is pretty much evident of the nadir, I would suggest, in ad tech, or at least pre-COVID, in terms of their trough of disillusionment. We've had a variety of exogenous sort of effects. We had regulation in terms of GDPR and CCPA, and of course, Google's announcement of cookie deletion coming in 2022. But I think things are going to come back. We believe that there's going to be what we call this endgame M&A as we consolidate operators towards this sort of slope of enlightenment. If we're going to put this on the 3 sort of eras that track the new company formation, the sort of maturity, and then the rationalization and consolidation, we are into that rationalization and consolidation phase. Perhaps the end game M&A, because of COVID, moves up. So we may start to see that now. And certainly there's been transactions like Rubicon Talaria and Foursquare Factual of late, just to name 2 in the last week, that may be sort of evidence of that end game M&A being accelerated. Now this third phase, if you will, or I don't know, call it the third age or the third era, or how about the third epoch? There we go. That word works because that's exactly the word that Sparrow Advisors, not NBC, used. Maya and Anna used this terminology of the third epoch that I highly recommend you check out that article. And it very much rang true in terms of the opportunity going forward, where we get this, again, slope of enlightenment, right? Migrating away from third-party data towards third-party data, migrating towards profitable companies. Hopefully, after this sort of final consolidation wave, we approach this sort of plane of productivity where we have fewer players, higher volumes, and lower take rates. And I think ultimately a healthier ecosystem for the industry. And for that, I want to turn it over to Anna, where again, her slides and thoughts on this type of concept of the third epoch is really consistent with our thinking. Anna?
Thank you, Terry. Yeah, I really like the word epoch. We started working on this kind of framework last year because what we were noticing in a lot of our engagements was that some of the macro trends can sometimes be hard to spot, because if you're focused very granularly on a particular side of the ecosystem, like maybe you're very, very deep on the buy side, it's very easy to miss the forest for the trees. So we charted the overall evolution of ad tech according to this, 3 epochs, roughly 7 years each timeline, because it roughly takes about 7 years from any new type of technology to emerge, mature enough to be adopted by enough people to be able to get to the next level. And lo and behold, this Epoch framework tracks very closely to Terry's M&A framework. And ours is wider because it looks at things like, are there enough people who understand the subject matter? Are there enough executives who can really move the needle for their respective businesses? And then what are some of the kind of the common trends that we're seeing in each epoch? So the first epoch we titled Shiny New Objects. This takes us back to the 2003 to 2010. I think it was the IPO bonanza, is what you called it. Sorry, not the IPO bonanza, the first peak, I forget now. But this was really—
Inflated expectations.
And that's great. That's a great title for it. But it was a really exciting time in the space. And if you were part of one of the early companies, if you're at 24/7 or at Invite Media or at Right Media, you really felt like you were building something very new and unique that not a lot of people were really understanding or paying attention to at the time. So it was this really new revolutionary way to buy, and we were all excited to now have a way to monetize things that were previously unmonetized and were not really being used. And because it was a technology first solution, we all kind of had this "yay, technology will save us" mantra that is very, very typical of tech first industries. Fast forward to 2010, when we're starting to see some of the successes coming out of that era, right? Larger companies, strategics are starting to pay attention. There have been some acquisitions. So now we kind of have market validation that this approach to audience data seems like it's going to stay if people like it enough. So we can kind of kick off this new phase, which we lovingly called the Wild Wild West. And I love how John Wayne's eyes just kind of peek at you in a very drunken way from behind my bubbles here. But some of the things that perhaps weren't so apparent were the downsides of this big advancement in technology. And on the revenue side, inventory cannibalization became a thing. The contention between programmatic channels and direct sold became a thing in this time frame. And we started to see multiple variants of fraud. In this era, we really forgot where the consumer sits. And if you have a conversation with other ad tech executives and your peers, it's very likely that the topic of ad blocking comes up, and you find out that somebody responsible for placing many, many millions of dollars of ads is also running an ad blocker. And that's a pretty surefire sign that the things are not quite okay in our industry. And so I have a perfect example that I like to use here. So Terry, if you fast us forward to the next slide. So I don't know if you all are familiar with Viber. This is a communication tool. That's my dad's face. We just finished a call. And because for the longest time, every question around monetization on the internet was answered by, oh, we'll just run some ads against that and that'll lead to revenue. I got served this ad, which seems to be for a bank that finances offshore drilling solutions. Now, why is this bank even running an advertising campaign? Why did they think they should target my phone for this? Why? So many questions, but really what I'd like us to walk away from here is that this is the experience for consumers. It's that dumb. This is what we've created as an industry. And so if we go forward, I can't help but use every opportunity I can to quote Jeff Goldblum.
Yes.
But it really is that. We were so excited about the technology that could do a lot of cool new things at impression by impression level, that it feels like we almost never stopped to think if we should be doing all of these things as an industry. So yeah, and now we're here in the third epoch, which is the maturity and stability epoch. Hopefully a more smooth 7-year period, we shall see. It's bookended by public companies emerging in late 2016, early 2017. We are seeing more regulatory and tech evolution concerns pop up globally. And we're trying to find alternatives to the duopoly. Now, depending on which region you're in, the duopoly or triopoly has a couple of different folks playing there, but the reality is that the majority of the spend and certainly the majority of every spend increase that we're seeing in ad tech is really going to just a fraction of companies, 2 or 3. And that's creating an interesting conundrum. And this is what will the world look like after third-party cookies go away? Going into this, we always had this assumption that the open web is something worth protecting and something that has a lot of value. But the commercial reality, and especially the acceleration of some of these commercial and technical realities due to the current COVID crisis, are really, really starting to question those initial assumptions that we've all made about the future.
Yep.
So I like to dust off my crystal ball here, and I think it's a nice segue back to your deck, Terry. And let's talk about what's coming next.
Yeah. So again, so far, we've done the easy work, right? Which is look at what happened, right? And try and encapsulate that in something that makes sense. Thank you, Anna. To think about the future, now where do we kind of go from here? I want to sort of make the case for optimism because it sucks to end on a negative note, and I also happen to believe it to be true that our industry is moving to calmer waters. Speaking of calmer waters, I mean, let's think about what's at stake here. There is $1.7 trillion last year in the global marketing total addressable market. And we very much believe that the technology application, so companies selling some kind of media, data, or software intermediation of that spend, have to date largely for the last decade focused on the above the waterline elements of efficiency. Everything is cheaper, faster, easier, and it's unquestionable that the application of technology, in particular to some of these workflows that were quite antiquated previously, that is the low-hanging fruit. That is the easy stuff to see. And yet we're big believers that the majority of the opportunity here is what lies below the surface in terms of improvements to efficacy, to ensuring that these solutions actually end up doing a better job, not just a faster or cheaper job. And it's really that focus on efficacy that where we think companies are really going to proliferate as, again, we get this consolidation. So everyone's cognizant of the fact that there's a lot of fragmentation in the supply chain between the principals of the marketer and the consumer, and between them now 22 LUMAscapes map over 5,000 independent companies. And yes, we've talked ad nauseum about some of the issues associated with this supply chain, the marketer-centric issues of transparency, measurement, viewability, fraud, and adverse context. And of course, of late, a lot more dialogue about ad avoidance, people preferring subscription channels to consume media, and of course, privacy. Well, and ultimately these are a function of trust, because the current model is challenged by sort of breakdowns in that trust because of complications due to the supply chain. Well, one of the trends that we take great delight in, that we've witnessed occur over the course of the last 15 years, really, but really ramp up of late, is this notion of this migration towards performance models, moving away from proxies like views and impressions and towards business outcomes. We saw that with, Google coming in with the CPC, other companies coming in with the CPA, ultimately moving towards business outcomes. And we think there's many benefits of this migration towards performance. One is it mitigates the aforementioned supply chain issues, right? Last time I checked, Belarusian bots don't actually purchase goods and services. So who cares if you have fraudulent impressions if in fact you're not paying for said impressions? If you're only paying for the business outcomes, it makes the point moot. Second is it requires, one thing about this connection chain, this closed loop, is that it requires attribution, which requires identity. So it makes identity paramount in a world that's migrating towards performance models for data-driven marketing. Third is it has a de facto increase in the operating leverage of the marketing intermediary. Essentially, the automation allows for your operating leverage to go up, and I'll explain more about that in a second. And finally, it makes the spend more resilient in times of crisis. So if your operating leverage is going up and your predictability of your revenues is going up, well, essentially that's going to increase your multiple and migrate you towards that third category of deals in terms of successful outcomes. What do I mean by operating leverage? Well, the tighter connection you have between spend and results, it fundamentally changes the nature of advertising spend from a discretionary expense to a cost of goods sold. It effectively moves it up the income statement. And all of a sudden you become a lifeline for your clients as opposed to something they can toggle on and off with good and bad times. You take, for example, companies that are doing, delivering new digital customers for gamers or app marketers like Uber or Airbnb. Essentially, they get paid a bounty, right, for all new qualified customers. Since they know the lifetime value, it's simple math, and there's no effective campaign off switch in any of these kind of interactions, which is why companies like AppLovin and Vungle have, cash flow growth parameters that would excite, anybody. They're essentially doubling every, 6 to 8 months their cash flow. And of course, as previously mentioned, identity is the core to this, right? If we, if you think about data-driven marketing, the goal here is to optimize the customer experience by sending the right message at the right time to the right person. We all agree about that. And yet the required capabilities of this used to be batch process, right? You used to run your planning, and then you would activate your data, and then you take a look at it. And months later, you would say, okay, this worked, that didn't work. Oh, I know a lot better when I run this campaign on the next cycle. Well, gone are those days when we had that kind of discrete batch process. Now it's this 24/7, always on circular sort of approach where you're course correcting on the fly. You do your planning, you ingest the data, you optimize it, serve the ad, activate it, whether it's in media or email or content or website, you measure it, you attribute it, and that connects back to planning. So it's very much a circular, connective, 360-degree perspective on data-driven marketing. And again, without attribution, you can't get there. And without identity at the core, you can't figure out attribution. So I think that's one of the cores. And probably why we are seeing, when it comes, bringing this back to sort of corporate development and consolidation, our primary drivers of M&A, and here they are, they're 4 and a bit, 4.1. And they are CTV, right? Convergent television. We've seen a variety of transactions in that space. As you get something as dynamic as a massive amount of spend going through a tremendous shift as people cut the linear cord and move to streaming, and a variety of technologies necessary to affect that. Identity, as previously mentioned, the key to data-driven marketing and attribution. We're seeing a lot of activity there. And mobile app monetization, again, a massive and growing component of the ecosystem that has the added advantage of having a closed loop and therefore very successful to do attribution. Add to this sort of what I'll call programmatic endgame consolidation, where we're naturally seeing combinations of whether they be public or private companies to sort of cobble themselves together to garner the kind of scale necessary for that sort of third epoch in to use Anna's terminology. And just to sort of punctuate these with deals, so here's just examples of our LUMA's deals in each of these categories, and you can see that there's quite a number of categories in each one of these contexts. Now, these are not mutually exclusive. You notice that each of these overlap, and two recent examples of overlapping rationale transactions. Last week's Rubicon-Talaria merger, I would say, is both CTV and endgame consolidation in terms of characteristics. And identity is Foursquare Factual is, again, both identity and endgame consolidation. So that's where we're seeing a preponderance of the activity that we're involved with, both historically, and if I could show you the, TBD tombstones in our pipeline, they would also match these areas. And one other area that's also seen a fair bit of attention is audio. Now I color that green because Sheila Spence at Spotify is doing the vast majority of these transactions. But yes, podcasting and audio based advertising channels are a growth area, and we are seeing some activity there as well. So this was the case leading up to February of 2020. And then, of course, look out, here came the coronavirus, which as it relates to M&A activity is essentially the biggest black swan event one could possibly imagine. COVID-19, both in terms of obviously the horrific initial primary health effects are traumatic and horrific, but really the secondary effects to the economy and what it's doing on the M&A markets are significant. And I would characterize those as, look, buyers act, they make investment decisions and find that trigger finger when they have a good handle on where the world is going. And so uncertainty is the enemy of M&A, because buyers just don't understand or can't comprehend what's likely to come, which is what has led to a current scenario of most deals being on pause. Yes, we were fortunate enough to get a couple deals over the finish line in the last week, and we are actively working on transactions, but a lot of deals understandably are on pause as the buyers say, look, really, we still want to do this. And that's the beauty of strategic deals, that third category of deals. If it's strategic, it's going to be strategic at the end of COVID as it is at the beginning of COVID. And I can't necessarily say the same for the other categories. That being said, most of our deals are sort of on a 30-day standing pause while everyone tries to figure out what the world is going to look like. And I got my fingers crossed that, we're reaching the apex of the health curve, and therefore that'll have an implication on the secondary effects as well. This will most certainly accelerate the capitulations, right? I mean, it's pretty near impossible. And of course, companies will prove me wrong on this. The exceptions prove the rule, that you can get venture funding, additional venture funding in times like this. It's certainly going to be restricted, and with no more capital, if you've got a business that's burning capital, obviously the time is ticking on you, and it's going to be challenging and will drive more companies towards a capitulation-like outcome. Also, valuations will undoubtedly drop. That would, again, comment relies mostly towards those capitulation or first or second category deals that I mentioned. If you have to sell, then yeah, you basically become a price taker, and therefore the scenarios like what's playing out in the current crisis will not be your friend in terms of valuation. I would say for the strategic deals, sort of doesn't matter, right? It's all optionality. If you have a truly strategic company, you're probably not going to be pushing for a sale right now, because you want to wait until the economy gets back on better footing and buyers have more confidence. So it likely does not impact the valuations of strategic transactions, and will have the effect. Therefore, if we're reducing the pricing on the first two categories, and the third category, the strategic deals, doesn't change, well, then the only conclusion you can have is it will widen the disparity of deal outcomes in terms of these categories. So that's our thoughts on consolidation and where we think things are heading. And now I'm looking forward to picking up the dialogue, and I see we already have a plethora of questions to get to. Thank you, audience, for the engagement and the participation. I guess before we go to the sent in questions, Anna, just a perspective from you on sort of the corona implications aspects that I discussed in the last few slides.
It's a great question, and I think one that we're all asking ourselves right now, because we're still fairly early on in the COVID path, it seems like. We have the benefit of having clients globally. So some of our clients in Asia, APAC in general, have kind of been on the more aggressive side of the COVID crisis. So we are now starting to see direct optimism from those regions. So that's good. I'm an optimist. I think that, you know, we'll experience a lot of short-term pain. There are certainly companies that are literally trying to figure out how to pay the bills, how to make sure they're not laying off staff, and how to survive. But I think that this will definitely accelerate some of the trends that we were seeing anyway. And instead of them taking, 3 to 5 years to play out, they'll largely play out this year. And I think we come out of it with a stronger ecosystem and more innovation and, the kind of advertising and marketing technology landscape that we should have versus having to rely on third-party cookies and similar things that were never really meant to be the main vehicle of monetizing the internet. So I'm really, really optimistic in the mid and long-term time frame, while recognizing that the short term is going to be painful.
Yeah. I concur. I think we've got a bright future on the horizon when it comes. It's just we just got to get through this period. Actually, so that sort of reminds me. There's been a lot of speculation as to when we think ad spend comes back and we get to a more sort of normalized market like we had in prior years. I'm going to go ahead and launch a poll. I have heard prognosticators. We're talking about people who would know folks from large marketing concerns, media agencies. Can you all see that question? I've tried to post an ad spend question. It's saying it's in progress. Can you see that, Anna?
No.
No. Okay. That's interesting. I launched it and it says attendees are now viewing it, but since you can't see it, apparently that's not working. That's unfortunate. So anyway, we'll okay, yeah, okay. Now I'm going to share the results, which no one participated in because apparently it didn't affect. Anyway, yeah, is this notion of I've heard everyone from Sir Martin Sorrell come out and say it's going to be a V-shaped recovery. We're going to be back in Q3. God bless them. I hope that's true. I don't happen to believe that to be a viable perspective, but I appreciate the optimism. Q3, Q4, sometime in 2021 or never? Where do you come out on this, Anna?
I wish I shared Sir Martin's optimism here, and I think we fundamentally disagree on what being back to normal means like, because what we're seeing on the brand side is that there's now going to be a new definition of normal, and the expectation that brands are just going to flip back to spending as usual and pre-COVID plans is I think a little bit premature, because what we're advising and what we're also seeing as feedback from the brand side is that they're really rethinking not just their advertising budgets, not just their overall marketing stack, but the allocation of funds. So if I'm a large CPG, maybe I don't need to spend money promoting, basic necessities that I sell, maybe there's a better way for me to funnel that money to my customers, to my partners, my retail partners, and the constituents in the ecosystem that have been really, really hurt disproportionately by this crisis. And so we're starting to pick up on those kinds of conversations, and a lot of internal focus as well. That starts from, are my investments to date sound? Are there opportunities to cut costs rather rapidly, but also to transform my entire marketing stack, for example? So between those two, the internal focus and the desire to not look at things through the same lens as before COVID, I think we're really looking at a much longer recovery. So I'm somewhere in this is going to take 12 to 18 months to come back to pre-COVID levels.
Well, that's interesting, and so you've got this sort of initial moment or issue to deal with in terms of how long does this take to sort of sort out, and then I think we got to think about how different will the world be even when we do come back. Right, this is what I call the third order effects. First order being health, second order being immediate impact on the economy. Third is, when we do come back, I think a lot of things are different, right? First of all, forget about 50% of the events in media and marketing. Gone. They were the bottom half of the events. Remember, 50% of all events are in the bottom half of their relevancy, or by definition. And so I think this will be as the great purge. I think there are certain channels, media channels. I think that as I mentioned, whenever you get a time of crisis. Take, for example, the financial crisis a decade ago. Spend in every major media category went down except for one, search. It went up. So the migration towards more tried and true, guaranteed ROI performance model. And if we're right about this continued migration of performance, and people think of this as cost of goods sold, that ought to tell you where you think marketers' mentality may come once we get through this.
I agree. It's marketers and consumer mentality.
And consumers.
If you've just gone through a crisis, you've lost your job, maybe you've been directly affected by the crisis itself. Like, you're not thinking about buying something frivolous. Like, you're still in shock, and that's also going to have a second order effect that we're not really able to gauge correctly right now.
Yep. We've got a question from a bearded, bespectacled, ginger Irishman, whom I think we all know and love. And he says in his normal sort of snarky tone, do people really think herding a bunch of cookie-based ad tech together will be good for the industry? Don't we need to go beyond cookies? I don't think you're going to get any argument here, Kieran. Yes, of course. I think you got to garner scale, first of all. So it's not dissimilar from big media companies garnering scale first. And then, yes, of course, they have to have updated tech that can give them the kind of universal identity capabilities necessary for said data-driven marketing that we espouse. And I think we're all going to need to, death to the cookie, long live, I don't know, the cracker. I don't care what you call it. Let's just, we do need some currency of identity in order to live in that forward world. I think the companies that combined are just doing sort of garner scale and market share. And yes, that's sufficient. That's necessary, but not sufficient. Yes, they will need some sort of updated identity currency. Interesting question around ad spend. Do we think, long question, I'll summarize it. Do we think that one of the consequences of COVID will be to accelerate digital, in particular digital video advertising, as opposed to more linear channels? What's your perspective there, Anna?
It's a really big budget that digital marketers have been really, really aggressively courting over the better part of the last decade, the linear TV budget. I think that it's a generational shift, and that linear television doesn't really make sense to generations who've grown up in an on-demand world.
Yep.
And you know, those of you with young kids at home or even teenagers, you can see this very, very vividly and very.
You mean when they try to pinch the TV?
Yeah. Yes, they try to pinch the TV. They don't understand the concept of like something only being shown at a certain time and those kinds of things. And I think it rather than kind of going, oh, is this budget gonna live here or somewhere else? I think we need to challenge ourselves with, well, what type of media and entertainment landscape makes sense given all the technology and consumer changes moving forward? And then smart brands will capitalize towards that. That'll probably manifest itself as an influx of money into digital. But I challenge you all to define, what does digital mean? Right. It's like calling, you know, electricity whenever you have a chance to call it out. Like, that's just something that we now understand is there, it's ever present. So we flipped from TV being the default mode to whatever digital means, or non-linear being a while ago.
I think what really matters is it addressable? So if it's addressable, then whether it's digital or OTT or whatever, I don't care. It's addressable. So I think there's a big difference between not addressable media and addressable media. The distinctions between which particular channel that's addressable, kind of irrelevant, so long as you have identity parameters where you can do the data informed methodologies. Exactly. I've got here's an interesting question about the split between subscription versus advertising supported video. We talked a lot about this in our Stream Wars webinar, where, yeah, sure, all the fanfare in the last 6 months has been around the launches of these primarily SVOD-centric sort of channels. Apple, we saw, you know, NBC's got Peacock. You've got, Comcast has got Peacock. You've got AT&T with, you know, HBO, Max, and the like. And I think, yeah, the early fanfare, the early adopters, the coastal high income demos are going to migrate towards SVOD, but even they will be limited in terms of how many of these subscription packages one will choose to pay for. But the vast preponderance of viewership, we believe, in the middle of the country, and as the later converters, the later cord cutters from linear, will all primarily be AVOD, which is why companies like Comcast launched with a primary AVOD supported business plan, and things like Quibi as well.
Oh yes, happy Quibi Day.
Happy Quibi Day. Happy Quibi Day. I saw a fascinating webinar. I encourage you all to check it out, that my good friend Rich Greenfield conducted yesterday. He had none other than Mr. Quibi himself, Jeffrey Katzenberg, on to talk about Quibi in its first day. It's a fascinating webinar. It's available VOD. Just follow him on at Rich Lightshed, and you can find it. Fascinating. John Grace asked an interesting question. If marketing moves into cost of goods sold, would most major brands move into running more marketing in-house?
Oh, that's a really good question, and it touches on the whole in-housing trend, which I maintain is really poorly named. But I think rather than a very binary answer, it's going to push brands to reevaluate what are really their core assets and the core technologies that they must own. And I think, you know, if you're a publisher, at some point you're probably asking yourself whether renting your ad server is a smart idea, and maybe you need a different approach. Yep. And these are kind of first principle types of questions, things that we haven't really challenged in the industry in a really, really, really long time, because we've been busy monetizing in the current cookie environment, that are all up for grabs now. And I don't think there's going to be a single answer. I think there's going to be a lot of, it depends on your company size, the vertical that you're in, and really understanding and identifying what's critical path and critical ownership for you, versus what are the things where you can construct a team of experts that can help you execute really well. And that's really going to be a very, very different model than what we've seen up until now.
Yeah, I think, look, if we just look to search, right? I think
Mhm.
search advertising is like the canary in the coal mine for other performance media. And what happened with large brands is, yes, so the answer is yes and no. So it's nuanced, as Anna suggested. And so, yes, you brought in keyword experts, you brought in certain experts in-house, but in terms of the technology platforms, they don't necessarily should live with brands. We've seen some brands acquire some technology platforms, but by and large, they tend to want to rent the best of breed. Someone anonymous asks, would you advise to start an M&A process now or better to wait till the end of COVID? Well, we recommend not doing a process at all. We don't think they work. And it sends a clear adverse selection signal to the marketplace that you're a seller. That having been said, if you have to, there are no buyers that are considering books, considering new investments right now. It is sort of like the null and void time. I know every process that's underway is largely on hold because you can't push on a rope. You can't force a decision from someone who is already indicated that they're not making decisions at this time. So no, I would certainly wait right now.
I have a write-in question that
Yeah.
I wanted to fly. This from Josh Edison in Australia. He was wondering what types of companies, and if there's a kind of a universal company indicator of the potential to very rapidly and successfully transform your business model to adapt to this new post-COVID, post-third-party cookie reality. And I'm wondering, Terry, if you've seen some patterns on that front of the companies that you think will be successful survivors.
Yeah, it's hard to delineate patterns across the broader ecosystem. I think anytime you've got a disruptive event like this, and it's obviously massively disruptive, you almost have to sort of rethink all of your go-to-market and retest all of your go-to-market premises. Clearly, people spending money on technology and intermediary sort of solutions are very much going to change their mindsets towards what works. So I think this notion of, you always had this, you had sort of like 70% of your core, another 20% that were sort of edge technologies or channels, and then you had sort of 10% experimental. That's going to go to 90-10 or 95-5, because this is the time you want to rely on your tried and true and trusted delivery channels and technologies that can basically drive results. I'm cognizant of the time. We're 5 minutes after the hour, and whilst we have 150 people still on, I want to be respectful to let people move on to their next Zoom meeting. So maybe we'll take one more question. I think you had another write-in, Anna?
I did, yes. This one's from Ben Young in New York. He was wondering what kind of effect will not just COVID, but the changing ecosystem really have on large acquisitions that closed at the beginning of the year. So he was mentioning Bain Kantar, for example. Yep. I think Viacom CBS also falls under this umbrella. But acquisitions and M&A transactions in general that potentially implied subsequent acquisitions as well. Like, how are they faring now, and are they also, or is their execution similarly impacted?
Yeah, well, I mean, I think in the case, we certainly have seen with the deprecation of market caps in the last month, pretty severe migrations down in market cap, and therefore, capabilities. You take a look at, you mentioned CBS, Viacom dropped under $10 billion in total market cap on a combined basis, which is, down really materially. Yes, undoubtedly that will affect their capability to execute transactions, because now if you're an $8 billion public company considering a $500 million acquisition, that is a lot more meaningful to you than if you were at 25 billion, obviously. Now, motivations for M&A tend to be both offense and defense. Oddly, these kind of run counter to each other in the sense that sometimes when you're under the gun and your market cap comes down, it makes it glaringly obvious that you need to go on the defense and maybe acquire some technologies that avail you of, new media channels, new technologies. And so actually a falling stock price can strangely be a catalyst for executing sort of defense oriented M&A. It certainly obviously prevents you from doing sort of offense oriented M&A. Maybe last question here. John Grace asks, if you rent your ad server, could you rent your entire marketing group? Have someone outside your company do everything on an SLA basis? I'm going to volunteer a high-level answer and then turn it over to you for more expertise. No, and no, because there are certain capabilities you need in-house. I'm a big believer that you ought to utilize the best of breed technologies, and that usually means renting, even though that's contra to my business of selling technology businesses. But for marketers, they really shouldn't own that much. They should have personnel that are experts, I think, that are in-house to represent them. And those in-house experts will know from which technology platforms that vendors offer will be able to offer them the best of breed technology solutions. So no, I think it's a bit of a hybrid between what you have in-house, what your trusted partners can provide, and then technology platforms. Anna?
I think I both agree and disagree here, and I'll qualify that by saying we tend to kind of look for solutions in general, but this really varies on what type of company you are. So obviously, smaller businesses and businesses where marketing isn't considered a core capability, maybe it's B2B folks, they've been very successfully outsourcing their entire marketing and advertising operations to other people for a really, really long time. But if you're a top 10 publisher, you using the same approach as someone who's a blog author and using essentially the same technology stack, I would say that that's a little bit suspect, and that's where you should really understand the opportunities for doing things a little bit differently. So I see a lot of stratification between the extreme top end, the middle, and specializations within the middle and niche areas, and then the long tail, and that those are going to require very different approaches. So if you've a sub $10 million in revenue and you're wondering whether you can farm out your marketing team, that's not really the right question to ask. It's really understanding what are the areas that you must own yourself versus what are the ones that you can let other experts.
Good answer. So obviously we're we delved into some of the specific trends around marketing, which is a great segue to sort of our next week's presentation and webinar. But I think I would conclude this one on consolidation. Think about where we are in the gestation. We are in this third epoch. We are in this sort of, normalization of the industry. Expect fewer players, expect accelerated consolidation, expect it to be better when we get to that sort of plane of productivity per the Gartner terminology, where we have this more rationalized sort of ecosystem. If you're one of the players, and remember, there are 3 different types of outcomes. Sadly, the majority will be in that first category. You obviously want to get to that third category. You want to be strategic. Talk to Anna, talk to us at LUMA about how to potentially manage that. But suffice to say that I believe that when we get on we've had a pause during this crisis, but when we get on the other side of it, I foresee a very rampant M&A marketplace where I think people scramble to do a lot of the M&A that they probably otherwise would have done, but for the whatever 6-month, 8-month, 10-month, 18-month hiatus that they took whilst things were sort of in crisis mode. And by the way, we won't have to wait for spend to come all the way back. I think all we'll have to wait for from an M&A standpoint is for us to have enough signals that we've reached the worst and that we're going to be coming back. And then I think people will regarner the confidence necessary to do M&A. As it relates,
Laura Desmond had a phenomenal comment on this at the Ad Exchanger podcast the other day. She was commenting on the same topic and looking at how can public versus private companies approach the upcoming consolidation. And she said something that really made sense to me, and that's that this is one of the situations where it may actually be to be a private company, because you may have more way to be aggressive about M&A as we start coming out.
Well, I mean, we'll see, right? I mean, the last 3 trading sessions, the stock market's up considerably. I mean, they're looking, stock market very much looks at the future, not the present. And so to the extent stocks come back, maybe the disadvantage won't be there quite so much. Anna, I want to thank you for joining us for this fascinating conversation about industry consolidation. Thank you all for joining. We'll see you next Wednesday.